The Investment Committee oversees the Fund's program through regular meetings and by analysing the meticulously compiled data from think tank that is consistently received, including the most recent data for the March 2024 quarter. Your Investment Committee has extensively reviewed all data received by think tank and confirms all information is up to date and consistent with the Committee's expectations for BMIL investors. The reporting framework adopted by your Investment Committee ensures early identification of potential challenges and is material for the ongoing success of the BMIL funds. In fulfilling its obligations, the Committee closely monitors the structured finance space, and this quarter has identified a clear downward trend in margins on new RMBS issuances compared to December 2023 quarter. The graph that is shown on screen provides a snapshot of the pricing on senior AAA rated tranches of rated RMBS issuances over the last 6 months. On average, senior RMBS tranches were priced with an aggregate margin of 104 basis points over BBSW in the March quarter, down from 134 basis points in the December 2023 quarter, prompting an expected recalibration for existing facilities scheduled for renewal. In all circumstances where margin recalibration will impact BMIL funds, your Investment Committee will prioritise the preservation of investor cash flow levels and will only accept adjustments that equate to a move up the risk curve, commensurate with risk-return outcomes that are aligned with the fund's objectives. The Investment Committee values the support of all investors and would like to let anyone watching these video reports know that BMIL regularly hosts investor information sessions at its North Sydney offices. These sessions offer a chance to explore BMIL's investment strategy and prospects and affords attendees the chance to pose specific questions to the team. You, as well as your friends, family and colleagues, are welcome to attend these sessions or any introductory presentations. To schedule a convenient date and time, please call Daniel, Paul or Alice on 02 8920 886. The March 2024 quarter has marked an intriguing start to the year. Economic data released in the quarter indicates a domestic economy that is responding to restrictive monetary policy, however, is still displaying strength in certain sectors, which is perhaps inconsistent with a traditional textbook description of how the economy should respond to higher interest rates. National accounts data for the full quarter ending December 2023 confirmed that real GDP growth slowed to 0.2% for the December quarter, equivalent to an annualized growth rate of 1.5%, and per capita GDP recorded another negative quarter at minus 0.3%, which is its third consecutive quarterly decline, signalling a fall in average incomes. Consumer Price Index, or CPI, data received in the quarter confirmed annualised inflation has stabilised at 3.4% per annum, with services inflation remaining persistently elevated, indicating sticky prices in this sector. Interestingly, the core category of inflation, which excludes volatile items, aligns more closely with the RBA's target range. Despite expectations to the contrary, official labour force data from the ABS suggested that the labour market remained robust in February 24, with employment growth and net job creation outpacing a rising participation rate. Unemployment fell to 3.7% in February, with the employment to population ratio remaining stable at 64.2%, the highest level in over 2 decades. The supply of housing stock in Australia remains below current demand levels and is contributing to rising house prices and rents. Data released during the March 24 quarter confirms that dwelling approvals declined to 5.8% from 12 months earlier, challenging the federal Labor government's recent pledge to increase the level of available housing stock. The chart that is shown on screen shows the seasonally adjusted trend in monthly approvals for new residential dwellings since January 2021. And research by Oxford Economics, also released during the quarter, suggests dwelling approvals must increase by at least 80,000 new dwellings per year if the government's housing stock increase plans are to be realistic. Following cyclical falls in December and January, lending for the residential property turned positive mid-quarter, the mortgage lending recording a moderate 1.5% increase in February. As the chart on screen confirms, there has been a gradual decline in lending since the low interest rate environment of 2021, and recent lending has been slightly skewed in favour of owner-occupiers. While economic activity is responding to tighter monetary policy, mostly as anticipated, its full impact has not been uniform, and your fund managers believe that more time is still required for the full effects to be properly borne out, and future economic performance remains uncertain. BMIL fund managers remain committed to the belief that the RBA board will seriously consider rate cuts in 2024, but without a notable persistent decline in real GDP or other significant shock to the economy, a rate reduction in 2024 isn't as likely as many in the market are making believe. I'd like to thank you for watching another of our quarterly video presentations.